The Federal Reserve raised the Fed funds rate by a further 75 basis points as expected this week. The statement did initially have hints of a possible pivot or slowing of rate increases, giving faint hope to bond and equity investors. Markets took the statement as a dovish sign and rallied. Gold rallied too for a moment. But then, in what one Bloomberg commentator called a bait and switch, Powell then went on to reiterate that rates are going up, adding probably more than people thought. After the initial surge, markets sank to finish far lower. The S&P 500 index surged 1%, then closed the day down 2.5%, its steepest drop since mid-October. Markets are looking for central banks to pivot to easier policy, which we think they will do next year as economic growth weakens and unemployment surges. But we also propose that there is an additional pivot on the horizon. As economic activity wanes, house prices fall, equity markets drop and mortgage rates rise, we suspect we will see central banks increase the target rate of inflation. As we reminded readers in a post back in May, the current 2% target was set by a fluke. Central bankers are of course denying that they're even thinking about doubling the inflation target from 2% to 4%, but central bankers change their messaging often. Remember, it was last year at this time that rates were still at near zero and central banks were trying to convince the world that high inflation rates were completely transitory and we would soon be back to 2% levels. A higher target inflation rate could end up being the central banker get out of jail free card. It enables central banks to pause rate hikes while inflation remains high as economic activity weakens and housing prices fall. And it also benefits governments by inflating away some of the massive debt loads that have built up through years of overspending. This pivot could play out as a temporary increase in the inflation target rate. Again, going back to last year, central banks were also proclaiming the message that inflation could run above target for some time, since it had been below the inflation target for many years. Some inflationary pressures have abated. Supply chains are being restored, for example. However, others are long-lasting new policies, such as friendshoring, aka protectionist policies. No matter the name, the resulting higher prices are a new reality. Another source of higher inflation for years to come is the move to renewable and sustainable energy. New price hikes are coming as technologies are developed, but the commodities that are needed to develop them are in short supply. One might ask why governments would support central banks increasing the targeted rate of inflation. There is a very simple answer. Governments like to spend more than they have, which has led to massive debt levels. And one of the ways to reduce the massive debt levels is higher inflation. Now, of course, there is one other way to reduce debt levels, and that is financial repression and austerity. The problem with austerity is that governments who choose this route are quickly voted out of office. And the bottom line, the Fed still has no idea what's coming next, which incidentally was the headline to our March post after the Fed raised the Fed funds rate for the first time this year. Finally, we remind readers that no central banker can inflate £5 of gold into £10 of gold. Paper currency is inflated at a pace controlled by governments and central banks. And one of the best reasons to own physical metals is storing wealth outside the system, which is built on debt and government promises. If you're keen to hear more about FOMC actions or any other central bank's actions and the wider macroeconomic landscape, then have a look at the rest of our YouTube channel, GoldCore TV. This week, we discussed access to rare earths and how the West energy supply hangs in the balance. And you can also head to goldcore.com, your precious metals experts, to see the charts shown in today's conversation. But for now, we will see you again soon.